Hey folks, Tapering here, the rate update. Today is August 26th, 2021. I apologize. I did some updates on my computer on 2 days ago, and nothing worked for the last 2 days. I finally got some patches and things like that, so I'm back. Perfect timing for the Jackson Hole meeting. Good to give you some updates on there. And one of the Federal Reserve, not chairman, but Federal Reserve members, they just came out today and said something about tapering that I didn't like. So don't go away. We'll be right back. Okay, so the consensus I have is tapering is going to happen. I mean, it's a fact, and I'll explain tapering here in a second. But I want you to listen to one of the Federal Reserve members talking about what he expects from tapering and what the time frames look like. So right here, and then we're going to discuss it in more detail here in a second. So don't go away. Watch this, and we'll be right back.
You know, it isn't normal that we have the pleasure or the need to have a single president on twice in a couple weeks, but things are moving relatively fast right now. And I want to just get your sense right now of the outlook for policy. You had been among those, the first really to call for an earlier taper as soon as September. And I want to know, amid the recent concern about the Delta virus and the Delta variant, do you still stand by that call?
Yeah. So we've spent, with this resurgence, we've spent the last week, 10 days, really redoubling our efforts to talk to contacts, do real-time surveys, looking at high-frequency data on mobility and engagement. And based on everything I'm seeing, I don't see anything at this point that would cause me to materially change my outlook. I'll continue to monitor this for the weeks leading up to the September meeting. But based on all that, it would continue to be my view that when we get to the September meeting, we'd be well served to announce a plan for adjusting purchases and begin to execute that plan in October or shortly thereafter.
Robert, tell us about those contacts you have. And you know, it's so interesting because the Dallas Fed is in such a diverse region. Used to think of it as only oil. That's not the case anymore. You've got high tech, you've got manufacturing, you've got energy. What are they saying to you about how the Delta variant is affecting the economy down there?
So we're seeing the impacts vary by industry. So if you're in the travel industry, it goes without saying, airlines, hotels are seeing some negative effects. But by and large, what we're hearing from contacts is they're weathering this resurgence at least as well as previous surges, and many are telling us that the impact on their business is more muted. So we're seeing resiliency, and I think the reason we're seeing that is because we have a much higher percentage of the population that's vaccinated, and we've got more tools at our disposal. And what we're seeing is consumers and businesses are just becoming more adaptable, more resilient. And I think people are accepting this is going to go in fits and starts. This may be not be the last resurgence we see, but people are using vaccines, masks, testing, and all of our tools to manage through it. So we're seeing resiliency.
To that point, when we talked in August a year ago at the first virtual Jackson Hole Summit, it was amid a surge. Do you concur with what Fed Chair Powell has said, that we're sort of learning to live with it? And I understand that comes with a lot of sort of loaded sense that, that you don't care about the people who are getting sick. And we know that's not the case. But from an economic standpoint, does it seem to you like the economy is really learning to adjust and people are learning to adjust?
Yes, that is what we're seeing. Now, I spent a lot of time with hospital leaders, and they are in a very challenging situation right now. And I've been in meetings with mayors, county judges, along with hospital leaders, where they're urging community leaders to do more to use the tools we have. But certainly, what we're seeing is businesses and consumers are learning to adapt and go on with their lives. And they're realizing that this is not going to be neat and clean or a straight line. It's going to go in fits and starts, and they're getting adjusted to that reality.
Robert, what is your sense about how the $120 billion in asset purchases are impacting the economy? Are they helping? Is it Is it keeping interest rates down? Is it making it more possible for people to invest? Or is it doing more harm than good in terms of driving up inflation?
Well, these purchases are designed primarily to stimulate demand. And that was very appropriate in 2020. It was appropriate in the early parts of 21 before we had vaccinations and widespread vaccinations. At this point, we don't have a demand problem. What I'm seeing is, yes, we're seeing shifts in the mix of demand in the economy, but we're seeing pretty strong resiliency of demand, and that continues to be our outlook. And we'll continue to monitor that. My concern is, along with that, we're seeing unintended side effects, excess risk taking, and particularly in the credit markets. You're seeing some distortions and excesses that I think are going to need to get normalized. We've talked about the housing market, and in particular, there's going to be a ripple effect from housing on rents and how those rents affect low, moderate income communities. So I'm concerned about the excesses and imbalances and unintended side effects. I think we'll be a lot healthier if we can soon wean off these purchases, and it'll put us in a lot better position going forward.
Okay, so some of the things that I took out of it, because I detailed this stuff to make it easier for you guys to understand. So what he said is basically tapering. They're probably going to mention it or bring that up at the September meeting. He wasn't clear on if they're going to talk about it in Jackson Hole, and I don't even know if the question was asked. So I think it might even rear its ugly head today and tomorrow for the Jackson Hole meetings. But we'll find out specifically once all the news starts coming out about the Jackson Hole meeting. But he said it's going to, basically he looks at tapering as starting in about October-ish. And then they asked him about the Delta variant. And then, he kicked that can around a little bit, said we're not seeing any impact there other than travel and leisure. Travel and leisure is huge, okay? The other areas where he said is, everything else seems to be resilient to it. So we'll see on that. So it's still kind of, a roundabout on what they're going to do. So here's my prediction on how this is going to lay out. They're going to bring it up at the Jackson Hole meeting, and it's going to hit the presses. And we're going to see, some sporadic things going on with the MBS market and the stock market and everything else. But we'll find out today and tomorrow if that's going to be addressed. But it is going to be addressed at the September Fed meeting. How that's going to be baked into everything, I don't know yet. Because what normally happens is when we know it's coming, it already reacts. And then by the time it happens, it's already baked into everything. So here's my thought on how my educated hypothesis on how this is all going to play out. We're going to see them bring it up at the September meeting. And then they're going to say, and what I'm thinking here is, we're going to let this Delta variant run its course, and we're going to see where it's going to go. So even if we start to taper, it's not going to be till October, November, December. I'm thinking they're going to look at more of November, December, because, and what's that thing I always tell you guys about? Forbearances and the extra unemployment benefits. All those are going away. So once all those go away, is the economy is going to downshift a little bit. We're going on, we're in gear 5 right now, flying, because there's a lot of money out there. And I know people are struggling, but there's a lot of people that are not struggling, and they're not making mortgage payments, and they're not making student loan payments, and they have excess money. So that's what my prediction is. I'm expecting them to make an announcement in September that they're going to, possibly start to taper minor changes, but it's really not going to take effect until probably Q1 of 2022. So that's what I'm thinking there. But let's get to the headlines that we see today, kind of all over the place. So you're going to see the video that I just played is right here, and hoping the Fed will announce tapering plan, and hoping Fed will announce. This is that person, this guy, gentleman right here, Robert Kaplan. He's a part of the Federal Reserve. So he's hoping that they start to taper in September. Well, we'll see. One article I wanted to address is, this is coming across the headlines on a lot of newsletters that I get, and a lot of things in regards to the mortgage industry, real estate, and so forth. So I'm usually, I don't get political. I don't try to get political on here, and I don't try to play anything in regards to race, color, creed, anything. I don't really care. I'm here to help everybody and anybody. All right. So there's a big hype right now. They're saying there was an investigation that the mortgage industry has these algorithms that are discriminating to people of color. So that intrigued me, and I'm like, how does my systems, now I'm in the business, my computer system doesn't know what color you are, okay? So let me start going down this path. What we do, let me walk you through the mortgage process, okay? And I know this is a little off topic of what we try to talk about with rates in real estate, but it plays a bearing here. Here's what happens with me, any mortgage company you use. 95% of us use two companies out there or entities out there to basically approve all the mortgage loans in the country. Fannie Mae and Freddie Mac. Okay, so let me walk you through how this works. You apply for a loan. Mostly everybody does it now online because it makes it much more simpler for us to send you out disclosures and all this other stuff because you consent when you do the online application. You plug in all your data, your name, your birthday, social security number, your address, all this, your income, where you work, your assets, and everything else. We pull your credit and we take that data and we bundle it into the computer program when we upload into Fannie Mae and or Freddie Mac. Their system then reads your data and then spits out and says it's approved or it's not approved. Okay, that's the basic terms. And then if it's approved, it just tells us what we need to get from you guys as the consumer to validate that approval. Nowhere in there, well, it does read in there that, your color or whatever, but nowhere in that underwriting piece is that a relevance. But a lot of research that I put into this is the survey that they used is a little flawed. I'll put it that way. Okay. Most minorities, I'll say I'm kind of a minority too. I'm second generation. All my grandparents were from Italy. A lot of immigrants, we might have lower paying jobs. We might have basically in a roundabout way, what I'm saying is we might have lower credit scores because of whatever reasons behind that. But a lot of brown and black and so forth have lower credit scores if you take a whole. Now, I'm not discriminating. Like I said, I'm just giving you the data, and I'll elaborate on this a little bit more as I dig into it more and more and more. So a lot of minorities and so forth, there's a program called FHA. And FHA is a program that will allow credit scores of lower quality, okay? Well, the survey that was done on here was only conventional loans. It didn't take into consideration VA loans and FHA loans. Now, if you did a survey of VA and FHA loans, you might see a completely different story there. That might be more skewed that there's more people of color getting approved in that system than white folks. So again, I'm not playing any race card or whatever, but I just like to dig in on these areas where there's the race card being played or there's other things that are out there, and I dig into it before I actually spew any information about this. I want you guys to get the facts. I am not going to say I'm right-wing radio, I'm left-wing radio or YouTube. I'm here to provide the facts to you guys. Okay, so that's what hopefully I did. So I'll dig in on this a little bit more. If you would, please leave comments down below, but I don't want to start a race war here or a political debate here or anything. I'm just giving you guys the facts behind it. So I read this article and it says, basically there's an algorithm out there that's hurting people of color, brown, black, so forth. Well, you have to really dig in on that data to figure out what was surveyed, and the survey is a little bit flawed. Okay, so that's that part of it. So hope you find a little bit of information from that. I personally, I don't care what color you are. We get most of our applications online. I don't even know what color you are. So I'm here to help everybody and anybody that seeks help from us. So that's that part of it. Okay, so that's it. So now we had the Jackson Hole meeting going on. Okay, I'm going to show you that data right here. It's the economic calendar. Jackson Hole meeting right here and tomorrow. Okay, some of the economic news that came in today. Initial jobless claims. How'd they come in? Well, kind of in line. Okay, that's pretty close. Well, the bad news is continued jobless claims increased by almost 100,000 people. Okay, that's a lot of people. So what's that doing to the markets today? Well, it's actually doing pretty good, but we've had kind of a crash in the last few days that I've been AWOL. And so let's get caught up a little bit. This is the MBS charts on what's going on for the quarter. Let me fill this in for the newbies out there. What is MBS? Okay, so what we try to dissect here is, we focus in on real estate and also mortgage rates. I try to teach you guys how do mortgage rates get created? Well, it's not the 10-year Treasury. It's not anything to do with any government bonds. It doesn't have really anything specifically pinpointing to the Federal Reserve. It comes down to what the yields are on the mortgage-backed securities. Okay, so that's what we focus in on here. So this number here is what's happening to the price of this mortgage-backed security. It's a bond that trades on Wall Street. As the price goes up, we love when the price goes up. Why? Because rates come down. There's an inverse relationship. Price goes up, rates come down. Prices go down, rates go up. So we like this chart today, or this number today. Well, you can see over the last several months, we've had a nice rally. But right here, we hit a top. And feel free to go back to my video from this area here. That day, I said rates were too low. Yes, I said rates are too low. And I thought we were going to have a little turn. Well, we did. We actually had a big turn. So this day, when I saw that we peaked and we started downturning and we hit this Fibonacci level right here, I started locking everybody and anybody that we had. I started locking in their rates. Good thing is because we had a complete debacle here. Rates probably went up about 25 basis points within this time frame. Okay, so that's what's going on there. But then we had a nice little reprieve. And right now we've been kind of consolidating. But for the last 2 days, there's been a sell-off. All right, I can't really pinpoint why because the economic calendars don't represent that. One area that I can say is the 10-year Treasury is starting to spike in yield. So why is that a concern? Because you're like, Dan, you just said it has no bearing on your mortgage rate. Well, it technically doesn't directly, but what you have to look at in this scenario is what are the yields on a mortgage-backed security and what are the yields on a 10-year Treasury? I've been saying for my whole life, as the 10-year Treasury yields continue to rise, it's a better option for people to invest in than mortgage-backed securities. So if I can get a U.S. Treasury yielding higher returns than a mortgage-backed security, I'm going to do that, okay? But the 10-year Treasury, it is up about 25 basis points in the last week. That is a huge move, and it's fast. So it's pulling money from this bond, and people are moving their money into the 10-year Treasury bond. Okay, so think of it as an investment. You have two choices that you can pick from. You have this bond yielding 1.1. You have this bond yielding 1.4. Where are you going to put your money at? The 1.4. Okay, so that's how that works. So we like when the treasuries have a lower yield. 1.4 on the 10-year Treasury is usually that point where people will move into the Treasury, 1.4 and above. Below 1.4, people are usually moving into the mortgage-backed securities, thus rising the prices up and the yields down, the more people that are buying. All right, so that's that part of it. The next thing is, let's get to where rates are. This is rates as of the 24th, and I know it's the 26th, but I don't have my report yet for today or yesterday's rates. So these are rates that are nationally. Okay, Black Knight is a company that surveys mortgage lenders all over the country, and we all respond and say, here's our 30-year rates. That's the question that they ask. And so this gives you an idea where 30-year rates are. Again, these are not my rates. These are just the generic rates throughout the entire country. So you might have a rate that's a little bit better than this or a little bit worse than this. Then we have a 1-day, a 7-day, and 4-week delta. What the delta means is the change. Okay, so a 1-day change, 7-day change, and 4-week change. You can see that there's really no change here. Okay, none. The markets are bouncing up and down and up and down and up and down. What we do here is I pride myself on what we do is when you guys call in, you can ask me or one of my mortgage advisors, we'll quote your rate. But what we normally say is we watch these trends. I'm the one that usually calls and says, lock them in, don't lock them in, float them, or do whatever. So what we've been doing lately is we've been kind of riding the storm. So what we offer you is we'll say, here's the rate we have today. We're going to continue to monitor that and try to find you a dip in that market. However, we see rates start to move up, we're going to lock you in. If rates continue to get better, what we do is we sit on the sidelines to try to find you a bottom. It's like a stock. If the stock keeps dropping and dropping and dropping, when do you elect to go in and buy that stock? Well, when you see it reverse and hit bottom. That's what we do here. So why would I lock you in if rates continue to get better and then you missed out on that lower rate? So that's one of the biggest benefits that we have that we do here. Okay, the rest of that, let me explain the rest of this numbers to you. Right here, you can see a 1 basis point adjustment. What's 1 basis points in actual numbers? It comes to 0.01. So it's basically irrelevant. So you can basically see here, we are stagnant for the month, okay? But again, if you pick individual days, you're gonna have ups and downs. So let's see where we are right here. This is the 30-year. I'm just gonna pick the top one here to make it as simple as I can to read. Well, let's go to the 30-year conforming. It's the blue line. It's right here. You can see we're at the same rate basically as we were back in March. Okay, if you go farther back, we were back, maybe a year or so ago, we were even lower or right at that range too. So basically over the last, 6 months, rates really haven't moved, but they have moved. And that's, we try to pick for you the ideal time to lock in. Okay, so that's that for today. So I hope you like my video. I know I covered a lot today because I've been away for 2-3 days, not because I wanted to, because I didn't have a choice. My editing software has been out. So if you're in the process of buying a house, or you're in the process of building a house, or you want to your options, does it make sense to refinance? Does it make sense to cash out and pay off other bills? You're in a forbearance and you're like, I don't know what I can do. Do I have options? Please, all we ask you to do is call us or reach out to us. We make this as simple as we can. The best way, or what most people are doing right now, is they're going to my website, therateupdate.com, and they're giving us a call. You can call 844-775-LOAN. Or what most people are doing right now is they're clicking here and scheduling an appointment. I have 10 mortgage advisors and myself. So you pick a day and time that suits your needs. And then you tell us, do you want to do this by Zoom or do you want to do this by phone call? You pick it. However you pick it, we'll make sure we're there at that time on that day, the specific way you want to review all of your details, all of your options, and we'll take it from there. So that's the best way I would, if I was you and you want to talk to somebody, schedule an appointment. We'd love to do a consultation with you one-on-one. So that's it for today, guys. God bless. Thank you so much for watching. Give me a thumbs up if you would. I missed 2 or 3 days, so I need your help there so we can hit 16,000 subscribers hopefully today or tomorrow. So take care. I'll see you soon. Bye-bye.